Welcome, everybody, to the Brian Fultis Behavioral Finance Podcast. My name is Dr. Brian Fultis, and I'm an associate professor of finance at Butler University in Indianapolis, Indiana, in the United States. And my goal is to teach you about behavioral finance in hopes that you can make better decisions in your life and with your money. Today's conversation is going to be about market efficiency. So thank you, everybody, for watching today or listening on podcast. If you haven't done so, can you please like and subscribe to my channel and follow us as we continue to hopefully teach you more and more about this interesting topic of behavioral finance. And if you're listening, then please drop some feedback, hopefully good, for us in order for us to continue to broaden our reach and teach as many people as we can about the area of behavioral finance. So today is, like I said, a conversation on market efficiency. And when we talk about behavioral finance, as we're laying the foundations here, we've got the psychology of money and the biases and the decision making on one side. And then the other part of behavioral finance is this market efficiency conversation, or challenging market efficiency. So many of us, when we think about are markets efficient, we always like to be able to summarize in a binary answer. So yes, markets are totally efficient, or no, they're completely inefficient. And what I want to do today is have a conversation that can untangle some of these things in order for us to have a clearer understanding of efficiency and some of the challenges that we still have, but create it in an open dialogue kind of way that is complementary to classical finance and the classical financial models, not there. It just sometimes seems to be contention around there. And I think we've gotten a lot better in behavioral finance and classical finance coexisting together, kind of agreeing to disagree on some of these different topics. But I also realize there are still some institutions that don't teach behavioral finance, that it's either no one's able to teach it, or nobody is willing to. And then there's also people who are so staunchly in the classical finance areas that they refuse to let anybody question their authority. And so anyway, that's why I'm trying to make this available. I'm doing this for free for the podcast. And I'm also concurrently building this course online. In addition, I do this every semester in class, but I want to do this online to be able to provide a comprehensive behavioral finance class to anybody who is willing to take the class, whether it's a college student who doesn't have behavioral finance offered to them, or just anybody willing and wanting to supplement their education in this area. So I'm working on all of this together, both free podcast and then down in the basement in the the Lightboard lab, working on this content. It also is nice, I'm not going to lie, that if I have a conflict of time for a particular lecture and I have everything done online, then I can easily say, hey, listen to this or watch this video in lieu of lectures. Now, you don't do that very often, but when you do and can kind of place them nicely, and you say, do it whenever you want, you don't have to come into class. There's two things that works out pretty nicely. They won't fight you on it because they can do it at their leisure, watching these supplemental videos. And then they actually appreciate you more when you come back into class. So that's what I've been told. A little bit of Brian goes a long way. So if you spread it out a little bit, less infrequent, or more infrequent, less frequent, then you get a better response. All right. Anyway, market efficiency. When we go all the way back to 1961 or 3, we have what is called the capital asset pricing model, or the CAPM. So if you've ever taken a finance class, so even my corporate finance class that I'm teaching right now, we learn about security market line and the capital asset pricing model in order to come up with risk and expected return. So I'm going to make a nice little chart here. But if you're listening, just picture the y-x axis. And what we have is mathematically, it's called expected return of a security or a portfolio equals the risk-free rate plus beta times the market risk premium, which is the expected return of the market minus the risk-free rate. Oh, here's my pretty picture and the actual equation here in front of me. Now, the risk-free rate is generally going to be T-bills or T-bonds, and I've seen it anywhere from 1 to 10 years. So just in our world, you basically can get a 2-year bond for about 4.2% as we're taping this, and 10 years, actually a little bit less. It's inverted right now, so I think about 3.66. This, I know I watch way too much CNBC, but 3.66. So we just say risk-free rate is 4%. Now we use these bonds, and again, I'm taping this in May, and we assume that for risk-free, we're talking treasuries from the U.S. government because they never defaulted, never expected to default. And I hope by the time this is posted in June that is still freaking true, that they haven't defaulted, because that would screw things up majorly. I don't think we really even understand what that'll do. So get our act together. Hopefully that's not a thing. We'd have to come up with a new model when our risk-free rate is shattered. Anyway, we've got risk-free rate, we've got the return of the market, what we'd expect the return to be, and that parenthesis here, the difference between the return of the market and risk-free rate, is the market risk premium. So the premium that you would receive for taking on risk for the market. Now, this beta factor is what kind of drives this whole thing. And beta is actually going to capture what we call systematic risk. So unsystematic risk are basically specific to only a company, or at the broadest level, an industry, company or industry risk. And then what we would expect you to do is take this. There aren't any free lunches, but this is about as close as you get in finance. If you diversify your portfolio, then you diversify on all of that unsystematic risk out of the way, both from a company level and an industry level. So what everybody else is left over with is called this systematic risk. So systematic risk, the way I like to think about it is if you have strong growth, GDP growth, taxes, inflation, all of these factors, they affect the entire system. They're systematic. So for better or for worse, they're going to influence the whole system. And so this beta actually captures whether your stock or your portfolio, how sensitive your position is compared to the market. So market, the S&P 500 is typically what it's compared against, is 1. So a beta of 1 is the risk that you would have being in the market. And so anything greater than 1 is going to be greater risk. Anything less than 1 is less risk. And so this is the way we priced assets for a very long time. So if I graph this, I like just give me the equation and I'm off and running. But if you like the picture here, you have a nice pretty chart, and that, okay, folks, not bad. I've got on the x-axis, this is our risk-free rate. So if you took zero risk, you would have this return. So this is what we said, 4%. If we had the market return, and we use the capital asset pricing model, that means we'd use a beta of 1. So 10% for the market, 4% for the risk-free rate gives us a market risk premium of 6% times 1 is our beta, plus the risk-free rate gives us 8%. So moving along the line here, you'd have an expected return of 8%. If I move up this line and I find a stock that has high beta, so think about stocks that would be highly influenced by market or economic outcomes. So think about, I think of like Tiffany's sometimes, Abercrombie and Fitch, I think is still a thing, even though I haven't been allowed in an Abercrombie and Fitch in about 20 years. So they always flag me and say, "Sir, you're way too old to be a customer here." You know, guy with his 6-pack abs. And then they say, "Well, and you're too young looking to actually have kids that would wear this yet." So haven't been allowed in there, but I can imagine good economic environment. People are going to spend more on these luxury products. And so you can see it's going to have some high beta fluctuations. Low fluctuations, I checked. AT&T, people are still going to need their cell phones in good or bad environments. Chesapeake Energy, I checked today. That's a low beta. And so the beautiful thing about that is as long as we come up with the right and can agree on the right risk-free rates and the beta measures agreed upon, the return of the market, we can place our expected return on this line. And it's very neat and orderly. And as long as everybody's acting completely rational, it fits. Well, that's what behavioral finance people came in and said, we've got some questions for you. We have some challenges here. So value is what a security should be after careful analysis. When we take a look at this, what value is what a security should be worth after careful analysis. Price is what the market says it's worth. So value, what we analyze and we say it's worth. Price is what the market says it's worth. Classical finance, the capital asset pricing model, says value equals price always. And there are never any disagreements on this. Value equals price always, all the time. Behavioral finance says value equals price generally, but not always. So we don't say never, it's complete nonsense. We say no, value equals price in general, but not always. And we have some questions that we would like to address or answer. And that's what starts this conversation on market efficiency. It's not a contentious, it's just, we've got some questions, so let's see if we can work our way through this. And that's how behavioral finance started. And when we talk about this market efficiency, I do kind of 2 strands of my research. And part of it is through experimental survey-based research in these biases area and behavioral biases. And then the other one is in challenging market efficiency. So I have just got my 16th publication accepted, which I'm pretty humbled about. And I feel like I'm the least likely person to be writing academic literature, but I like doing it. I like running through the numbers, and it's the best part of being a professor, in my opinion, especially with my kind of personality type, where I love being outgoing in my classes, the center of attention, like lead singer-itis. I love being on stage and being the center of attention. I don't use PowerPoints anymore because I want everyone to look at me. But at the same time, I am totally content digging into a data set and crunching numbers and figuring out how does this work? What have been the returns historically? How do we challenge this? And so anyway, I found my spot, my sweet spot, and that's just me in a nutshell. So anyway, a couple of the questions we have. Why do some individuals earn excess returns? If everybody is fitting on this line, why do some people earn excess returns? And what we need to understand is excess returns means after factoring in risk and costs. So that anybody can earn a lot of money on average just by taking on an extra risk. That's what the capital asset pricing model actually captures. But we say no, even after factoring in that beta risk, they're still above it. So why does this happen? And then why do some trading strategies that we're going to learn about, why do those earn excess returns after factoring in costs and risks? So what we assume here in all of these, in this capital asset pricing model, we have three major assumptions that I want you to think about going, okay, here are the assumptions. Here's real world. Okay. Number one, security prices should respond quickly and accurately to new information. Quickly and accurately to new information. That means new information pops up, everyone captures it, boom, new price, no disagreement. So you can see if somebody has a negative earnings announcement, price goes down, and then everyone agrees on it right away. That's not the case. In fact, there's an overreaction to the negative, and the overreaction is prolonged for a number of different reasons. Some say it might be emotional. Others say it might be these larger institutions taking time to get out of these monster positions. And then those who have margin calls are having to sell out of it in order. So there's some different market forces going on. But if you think security prices respond quickly and accurately, boom, to new information, and they just settle from there, that seems to be a bit of a stretch. Number two, everybody agrees on how to interpret this news. That kind of falls into the same area where if you have negative announcements, how many of you have ever seen a company who beat earnings? So expected earnings were 60 cents a share, and they came out and they beat the street or beat analysts' expectations by a lot. So even if they were at 75%, they beat earnings by 15 cents a share. And you look at it and go, oh, wow, there must be a nice pop in the market, or it might go up. We go, no, it's actually down. You go, what? Why is that? And not everybody agrees on how to interpret the news. Even if the analyst said 60%, maybe the other insiders or other investors were expecting 80 or 85. So when they came in at 75% or 75 cents per share, market actually went down based on that news. Same thing as far as interpreting forecasts. When have economists ever predicted any of the last of our recessions? Any, go back as far as you want. When have economists in general forecasted any of this? And so anyway, that's a whole nother story. And then number three, all simulated trading strategies should fail over time. So simulated trading strategies, they shouldn't work because it has nothing to do with perfect pricing on this line. So even if it does, then over time, it's going to revert back to its mean, and it's not going to be effective for any considerable amount of time. And so we say, okay, well, not quite convinced on all this, but let's dig a little deeper. I want you to define market efficiency. So we've kind of evolved into this, and we've actually categorized them into three different types of market efficiency. Number one, you think about this one. This is called strong form. Strong form implies that all information, past, present, and future, is known, including private information, is factored into the stock price. So all information about a particular stock, all stocks out there, past, present, future, private and public information are known by everybody, and it's all factored into the stock price. Well, think about stocks, go, well, trying to think in my own world. I know my fiance knows me pretty well. My kids know me pretty well. I've got some friends that I've been lifelong friends with for many, many years who know me very well. And trying to think if anybody has all information on me, past, present, and future, private and public information. And I don't think that's it. I'm kind of thankful probably that not everybody knows everything about me, past, present, future, private, and public. And so we say for that to happen, even in our own world with our best friends, like this seems too far-fetched. So we kind of discounted that, and they said, well, no. Let's call this now number 2, semi-strong form of market efficiency. And when the classical finance says all public information, past, present, and future, is known by all participants. We go, okay, so the only way of earning excess returns in this environment, assuming this is true, is through obtaining private information. Yeah, so anything else is not going to work. So when we talk about some of the different challenges in a future chapter, these are going to mostly be challenges of the semi-strong market efficiency. And then third is called weak form market efficiency, that infers historical prices and returns. All historical prices and returns are known by all. So if everyone knows basically the chart of what's happening, then technical analysis using charts in order to influence our buy and sell decisions, our entry and exit points, would not be possible or would not be profitable because everybody would already know that information. So, and by the way, I've written a few papers on technical analysis and trying to find out the efficiency, and have found some pretty interesting things, but in favor of using even a simple form of a simple moving average. But the joke I like to make with my class is I do know of a way of guaranteeing profits for technical analysis without fail, guaranteed profits. And that is if you actually write a book on technical analysis, that's your way of confirming profits. If you use it for your financial decision making, well, there is nothing guaranteed. Sometimes we do find evidence of it actually helping, and sometimes we find no evidence at all. So this hasn't been as robust, but I do still teach it, as I know that a lot of people in the market use this particular method, and they couple it with their fundamental analysis, and they use technical analysis. So sometimes it can become a self-fulfilling prophecy if a number of participants are still using this. So I still use it to a certain extent as just a check-in. It's not a main driver, but I know a lot of people who are really passionate about it, and they go, oh, it's clearly a head and shoulders. And I'm like, no, come on, you're misperceiving randomness here. But sometimes you have to recognize a clear trend is a clear trend. So kind of taking a more balanced approach to this, in my opinion, is where I like to live. So anyway, back to the semi-strong form. One of the first challenges came out in 1981, and this was Joseph Stiglitz, and he had a challenge to this, the semi-strong form, and he said if all available information would be immediately and fully reflected in prices, who would then have motivation to produce or gain any information? So follow me here. One more time. If all available information would immediately and fully be reflected in prices, nobody would be motivated to produce or gain any information. But then if nobody's motivated to produce or gain any information, how do prices reflect all information? This is called the information paradox. So you can see that circular logic coming all the way back and not being completely fulfilled. All available information. He's getting the information. Who has all the information? That's what came out, and that's called the information paradox, and that is a direct challenge to the semi-strong market efficiency. And the next one, so if you thought I only had one paradox for you, I got two waiting for you today. This is actually called the joint hypothesis problem. Okay, so to test market efficiency, you must have two maintained hypotheses. All tests of market efficiency have two hypotheses. Number one, markets are efficient. And number two, the pricing model is effective. Markets are efficient, pricing model is effective, which then means that rejection of one of these is markets are not efficient or the model is faulty. But because there are two of them, which one is it? And so this is where we're trying to refute or challenge some of these and saying, okay, I've got a challenge here for your semi-strong market efficiency. And they say, okay, well, which one are you challenging? Are you challenging that markets are efficient or that our model is faulty? So when we came out, I didn't do it, but evidence came out in the 80s and 90s, and it was shown that small cap stocks, smaller companies, outperformed large cap companies. And most of you should hopefully be saying, well, sure, of course, they should have outperformed. They're more volatile. And that's true. However, even after factoring in the beta risk of these smaller stocks, it outperformed large cap stocks in general. So even if we took the top third and bottom third of large cap to small cap stocks, you found this effect was significant over the analyzed time. And so we're saying to reject it, what are you saying? Is this just rejecting semi-strong, or are we saying that the model is faulty? Well, it's Fama French. So Eugene Fama and Kenneth French came out and created the Fama French three-factor model. After it was found that we found another thing, that value stocks outperformed growth stocks when we analyzed it the same way. And so in addition to the beta measure, Fama and French came out and made their Fama French three-factor model, which now has beta, small large cap, and value over growth. And so that was satisfactory for quite a while and kind of cleared the air about this conversation because they set it back in place. The model is now effective. But then we had some pretty robust findings in serial correlation, or what we know as momentum. And momentum came in. Well, Carhart came out and added momentum and acknowledged it as a factor. And now it's moved into the financial models that are now used. So this is an ongoing conversation. And I don't know if we're ever going to have a resolution on this, but I find it very fascinating that we are very complex individuals. And I always find it very good for my job security when I'm analyzing people's financial decision making that there are always going to be issues and suboptimal decisions being made. And I don't have to look any further than myself to get new ideas of suboptimal decision making. So this will be an ongoing thing. And I also feel like, because people are so inconsistent and so different that it's tough to capture our behavior in a mathematical model. And I believe that, when we're talking about self-driving cars and how do they predict our unpredictability? And so if I'm coding this, as a software engineer, how do we predict that, Karen soccer mom is going to be swerving all over the place and on her phone because she thinks she's a brilliant texter and driver at the same time heading to soccer practice. How do you capture all of this? Anyway, that is, we're going to have a future conversation on some of these additional challenges to our market efficiency. But I am going to leave it alone for now as we just set that foundation of markets and efficiency. And now we know a little bit better now how to define it and just understand that we're not tearing it down. We're just challenging it, and we're asking questions, and we're bringing our own behaviors and observations into to challenge the mathematical models. All right, so I've said my piece. Thanks for sticking with me. And if you do have any questions, please let me know below. And if you want to connect with me, you can find me at brianfoltis.com, or you can find me on Instagram, Brian Foltis. And if you are looking for the course content, you can find that on Brian Foltis, or if you are looking for somebody to speak or teach at a workshop for your congregation, your business, small group, keynote speech for conferences, I am your guy. This is my passion to talk about, and talking about behavioral finance and trying to teach as many people as possible is my goal. So thanks again, everybody, for listening and watching. And when we come back, we're going to have our deeper conversation into one of my favorite topics, which is called prospect theory. So thanks, everybody, again. Have a wonderful day, and we'll see you next time.